Hello, accounting superstars. This is Professor Don Bush from the Accounting Superstar YouTube channel. You've come to the right place to learn accounting. I've been a professor for about 30 years, CPA for about that long, and I've got great ways to explain accounting. So today's lesson is for students who are in their first semester class of accounting and learning about fixed assets and depreciation. So today's lesson is going to be about straight line depreciation. Very, very simple. So let's get started. Well, a university here, Accounting State University, is buying an accounting professor, one who makes YouTube videos, a Rolls Royce for his own private use. I wish. So here we go. So the cost of this Rolls Royce is $350,000. And here's a picture of it right here. Really nice. The expected useful life is 5 years. So they expect that this professor will drive this Rolls Royce for 5 years. And at the end of the 5 years, this Rolls Royce will only be worth $1,000 or $100,000, only $100,000. So here we go, folks. Here's the formula to figure out straight line depreciation. It's really easy, guys. And by the way, what we're doing when we calculate depreciation, we're figuring out how much we're going to expense this car each year. That's really what we're doing. We're expensing the car on a regular routine basis. So the formula is cost minus salvage value divided by the number of years. So the cost is 350 grand. Salvage value at the end of 5 years, it'll be worth about $100,000. So 350 minus 100,000 is 250,000. And if you divide that by 5, you get an even $50,000. So in other words, the university is going to expense this Rolls Royce at a rate of $50,000 per year. So here's the accounting entry, folks. It's easy as can be. And this accounting entry is always the same too. You debit depreciation expense because expenses are debits, and then we credit this strange account, accumulated depreciation, for $50,000. So there we go. There's the journal entry. So as far as the financial statements go, the depreciation expense will end up on the income statement right here, 50 grand. And, well, expenses are expenses. They reduce the profit of the company, or in this case, the university. And then the accumulated depreciation is going to flow over here to the balance sheet. So here we are on the balance sheet. We've got the vehicle. What we're going to do is we'll list it at its original cost. Its original cost, again, was $350,000 right there. So 350 grand goes in that spot. Now the accumulated depreciation as of the end of the first year is 50 grand. And therefore the book value is going to be 300,000. Now what's the book value? The book value is, according to the books, this is what the Rolls Royce is worth. And of course that may not be reality. I've made a few other YouTube videos about this. So book value, it's simply, according to the accounting records, this is what the car is worth. Now, one last thing about this accumulated depreciation. At the end of year 2, this accumulated depreciation will now be a negative 100,000. And then at the end of year 3, it'll be a negative 150,000. Do you see the picture? At the end of year 4, negative 200,000. And so on and so forth. So there you go. So folks, I hope you enjoyed this lesson. If you did, let me know. Hit that subscribe button and the like button. Also, check out my webpage, accountingsuperstars.com. I've got all these videos listed by topic, and so you can just click on whatever topic you want to learn about. So until next time, over and out.